Hey everybody, this is Robert with the Money Coach Show and my colleague Damien. Tara is out right now. She's in some business meetings, which we really appreciate here at Lone and Key. So with that being said, I'm going to go ahead and start the show off with our market update. You know what? As we had mentioned few weeks back in episode 5, there was feds were cutting rates, but as anticipated, because Tara, she's amazing at this. This is why I kind of miss her having her do these market updates, but she predicted quite rightly, we're going to see a decrease, but then they did kind of go up, in which it's not the greatest news, but here at Lone and Key, we want to make sure we inform you with all the news, even if it's bad news, and it's not looking so great, but at the same time, it's still lower than what you can possibly get, considering in the past 6 months. Because you know what, it's just how rates are. They fluctuate, and we want to make sure that you guys can see exactly what's happening. And with that being said, I'm going to share my screen right now so you guys can actually see what we look at on a daily basis. So right here, I have what's showing our conforming FHA, VA, USDA loan, the average closing. And this is within the past 6 months. So, this will pay homage to what I've been barking up for the past several episodes about the cost of waiting. If you're waiting for that perfect rate, look at what happens. If you can afford now, reach out to us at Loan and Key so we can shop these rates for you and get you in while the iron's hot. Because you know what, this is super important to understand. You know what, hey, rates do fluctuate. The Fed said that they're going to cut rates, and rates did go down a little bit, but then they went back up because, Damien, you can agree to this. Banking institutes, they try to fit this in before the rate came, so they can
They
already.
already had this baked into the numbers. They it's so unfortunately, yeah, just like Tara had mentioned in episode 5. We're hoping with the Fed rate that rates would go down, but it wasn't a guarantee. It's potential that they could go up, and unfortunately, they have been going up incrementally, not in huge amounts, but going up. And unfortunately, that's not the direction we'd like to see them going.
And
But
this is what keeps them solvent. It allows them to have operations, because they can't just give everything away. And as I mentioned in our last episode, it's still, I'm going to steal Warren Buffett's line, and I did in the last episode, that you know what, a mortgage is the cheapest you're ever going to be able to borrow money at. $300,000 at, I'm going to say 7%. That's still extraordinary cheap. And then again, so with that being said, how to capture the best rate possible. What we're going to do is I'm going to show you, some great things that are going to inform you some great things about credit. What's a hard credit, what's a soft credit pool. Because again, I'm going to go ahead and, forgive me for doing this. I'm going to go ahead and just share
no,
my screen.
show 'em, Robert. Show
Yeah,
them. Yeah, share your screen. Show them.
because it's super, super important about understanding what you can actually get into. So you know what, I want to make sure that you guys can all understand that, because again, here's my screen again. I'm going to take away everything right here. So you know what, and what we can also look at is what your credit score is going to be like. So for the most part, majority of Americans, first time home buyers, they're going to get in with less than 20%, because you know what? Hey, it's the most advantageous way to get in. Hey, I can get in at 3% with a conforming loan. If it's a FHA loan, it's a 3.5%, and again, we can shop that for you. And say if you have a fantastic credit score, excellent, above that 740 marker where it's nice and healthy, it goes to the gym regularly, as we like to say, and gets that pump, you get a better credit score, and then if you don't have that not so great credit, less than 700, you can see in the red, it gets a little bit more expensive, so we want to make sure we can help you understand what that looks like and what, things can be like. Now, say if you do have at least 20% to bring to the table, we can actually even look at that, because again, we're coming over here, and these are, mind you, these are just conforming loans here. It's not FHA, these are just conforming. But if you have, more than 20% to put down, as you can see, I'm going to go ahead and take away the less than 20%. You can see you're still capturing in at less than 6.75% interest rate, and this is where, we would all like to be. but unfortunately, not everybody is. We can navigate you through that, and we can even see, hey, if you don't have that great credit score, and as you can see, upon this line here, it jumps a lot, so this is why we want to make sure that you guys are well armed with as much information as possible to make sure you have a healthy credit score. So there are two type of pools. We're going to go over that real quickly. Okay. First, I'm going to go over a hard credit pool. Okay. So you're going to get a hard credit pool when you're applying for a new credit. So if you're applying for a new credit card, I don't care if it's at Sears, I just bought tires last week, and you know what? They were at Firestone, and no plug to Firestone, but they were like, hey, would you like to apply for credit? You won't have to pay interest for the next 6 months. And it's like, no, because you're going to pull my credit, and my credit score will show that. And everyone knows it will go down a little bit once it's pulled, even if I don't utilize that, and again, we want to make sure that you're financially savvy so you don't have to do that, and luckily I didn't go and use credit. I just said, you know what, I had the money for it, so I bought 4 new tires because that was the most advantageous thing for me to do to protect my credit. So back to when the hard credit pull is going to take place. When you're purchasing or leasing a car, they're going to run your credit, and so when you go to that car dealership, don't let them run your credit. Shop around, see what kind of car you want, before you have your credit pulled. Because again, if you're going to buy a house, I'm going to suggest this right off the bat. If you bought a car 6 months from now or 6 months ago, chances are you're not trying to buy a house. And if you're buying a house right now, say if you're already going through it, don't go out and don't go out and get a car, because that's going to jack things up. Your credit score will go up when they see that you're purchasing a house. So don't go out and use that credit line, because that happens a lot. And then when it gets to the underwriting desk, they say, hey, a new line of credit's been pulled. Your DTI is higher. We can't give you this loan. And here you are with a brand new car when you wanted a house. So be very
Hey
cautious of that.
Robert, hey Robert, sorry to interrupt. How long do those hard credit report pulls stay on file, or like how long? Because I'm sure it shows on your credit report when somebody requests, but how
Oh,
long does it stay on file for on your credit report?
well, what? I'm going to go over that right now. I don't mean to be a
Oh,
politician, because I'm going to give you something else first. As it is, it's political season, but we digress from that, because that's not what our channel is about. But I will, because it does, and I'll just tell you now, Damien. So if you're just even doing a credit check and it's a hard pull, it's going to stay on there for 2 years. It's basically the equivalency of your financial underwear being exposed, where they're going to look at everything, your delinquencies, the on-time payments. Anytime your credit has been pulled, again, it's going to show up for 2 years. So if you come to us at Loan and Key, and we start going through the gauntlet of going through that pre-approval process, and we pull your credit and have a hard pull, because hey, you want to have that pre-approval that's as good as letting them know you're good for the money. We're going to do it, and we're going to be able to see how many times this was done, so we want to make sure that we're very cautious with your credit when it's being pulled. We're not going to, and I've heard of some horror stories where, and I hate to even go here, where it's like, again, when you're applying for, an apartment or leasing an apartment, they'll do a hard credit pull on you to see how credit worthiness you are, and again, this is why a lot of people, and I've seen it when I was a renter, I stayed at my apartment for several years, but again, you see it all the time, where people in and out, in and out, in and out. It's like they're getting their credit pulled all the time for this, and that's terrible. We don't want that to be you. We want to make sure you guys have, the financial intuitiveness to understand how to do what I'm going to talk about next. And that's going to be a soft credit pull. Now that again is something that, if not done correctly, you can damage your credit score, because what you'll do is like, oh, let me just go do a soft credit pull. I may not be purchasing anything. I may not be getting a loan of any type or any type of credit. But if you do it incorrectly, it'll pull it from 3 major credit bureaus, and then that will show up on your credit score or credit report, and that will lower your credit score. So, a soft credit pull, if you want to check your own credit, we will walk you through how to do that, and that's basically pulling that soft credit pull, and it's usually only going to one agency, and you can do that at their direct website. We will navigate you through that. You contact us at Loan and Key. The other thing is going to be for, that that I want to get a soft pre-approval, not that hard pre-approval where you're going to be able to go to, that realtor and say, hey, I'm completely approved for this. It's basically understanding, well, what my credit looks like at one of the major credit bureaus. And you know what? This is where contact us and we'll be able to give you that information. Like Damien said, and rightfully so. I can't give you all the information here on the channel, because it's a longer conversation and we don't want to bore your ear off, death by PowerPoint, as many of us have been done before. And we don't want to do that. So we want to make sure that you guys have a clear understanding on what your credit score looks like. The other thing is going to be employment background checks. They do a soft credit pull on you, whether you like it or not. And I'm going to say, Damien and I, we discuss things all the time. And we were even talking about, hey, if you go into a company where they're going to give you a salary, more than likely they're going to do a soft credit pull on you. Because again, they're giving you money just based on the increment of time that you're going to work. So they're going to do that soft pull. Make sure that you ask that, hey, are you going to do a soft pull or a hard pull? Because even, some of them may even do a hard pull, because there's some employment agencies that not only will they do a credit pull on you, they'll do a criminal background check, and that's when they'll do a hard pull on you. So you have to be very cautious and ask them of that. And even some cases say,
especially in banking, especially jobs having to do with banking, financial institutions, things where there's involvement with money or any kind of fiduciary responsibility. Yeah, that's pretty common.
yeah,
Very, very
because again,
common, actually.
we Damien and I have both been there. It's like they want to make sure that you're an upstanding person of, and I hate to even say it, it's like paying your debts shows that you're credit worthy. That's in the modern day. We've all heard, and that your word is only as good as your bond. It's like, hey, it's your credit now. They're gonna look at that. Because mentioned earlier, it's your financial underwear being exposed. And everyone shouldn't see your underwear. I know Damien loves that term, but it's the
I
truth.
do.
It's a financial truth. And again, but much like your underwear, not everyone should be seeing what's on your credit report. It's like only your responsible, loan officer, brokerage, because I'm going to say it all day long. You have to go to a broker. Don't go to your big bank. Don't go to the big lender, because they're not going to give you the best deal. We at Loan and Key, we're brokers. We will shop around for you. We will be the only ones that are examining your credit. Take it back. Let me take it back, because again, honesty and transparency is here. We do have to share it with two other people with inside of our department. And that's going to be processors and underwriters. We're going to talk about that process in the next episode, and maybe not the next one, but the following one, what they will be looking at. But they will look at your credit score, because they're going to compile your debt to income and make sure everything is copacetic. The funding department, they're going to go off the word of the processor and underwriter. They're going to be like, okay, Mr. Jones is ready. We're good. Send it to the funding department. So that's basically how that would go. So, and then also with the soft credit pool, if you're gonna, hey, you're opening up a new utility account, whether it be, a lot of times it's, town, city, they do a, I've done it, in Southern California, where it's like the, county of Riverside, they will do a credit pool, soft credit pool on you. So, and it's basically understanding how much of a deposit we need from you.
Yep.
If you have great credit within that soft credit pool, it's going to be a lower deposit. So, and then back to what Damien asked, soft credit pools do not affect your credit, but again, if it will show up on your credit report, hey, a soft credit was pulled here, but it's not going to affect your credit score like a hard credit pull. But like I said, both of them will stay on your credit report up to 2 years. So we want to make sure that you have that understanding. So I know you guys have heard me enough. And you know what? If you have any questions, any further questions about credit scores, how to manage them, how to responsibly navigate your way through it, reach out to us at Loan and Key. All of our information will be down in the description below. And you know what? If you're finding value in what we're saying, regardless what it is, whether it be, the market update, the mortgage tip, the financial guru tip that we're going to get to you in a few moments, like and subscribe, because this helps us, and we want to make sure we can reach out to as many people as possible, because this information, what, a lot of people don't know, it's freely given, but a lot of big industries don't want to give it out. We here at Loan and Key feel it's our, again, it's our code, it's our, code of ethics to be able to say, hey, you know what, we want to make sure we can give you a sound advice. And even as much as I'm going to roll my eyes, even if you don't use our services, we want you to be financially armed because, at the end of the day, we want to help people. We're in the business of making sure we can, if we're on that topper scale of the mountain, we're going to put our hand down and reach out so you can be up here with us, even if it's not using our services as much as we would like you to. We want you to be well armed. So with that being said, Damien, take it away with our financial guru tip because you know what? I have my notes here. I'm going to be taking notes because anytime you do, I definitely take notes because you got to
No,
take heed
no,
to any
no.
type of
Thank
financial
you, and
tips.
thank you, Robert, for a really good market report. Also, a really good in-depth description about what's going on with rates, what's going on with what kind of rate you could get with your credit score, why credit worthiness is so important. So all really, really important stuff, Robert. Today's financial guru tip is going to be covering IRAs. So I have mentioned them briefly, I believe, in the previous episode when we were talking about 401ks and rollovers. So 401ks and individual retirement account, sorry about that. An individual retirement account is the type of savings account that is designed to help individuals save for retirement while still enjoying certain tax advantages. There are several types of IRAs, but there's only two that are the most common. I'm going to go ahead and talk about the most common, which is your traditional IRA. Your traditional IRA is money you contribute. It's typically tax deductible in the year that you make the contribution. So that means you might get a tax break up front. So yay, that's good news. Now taxes when it comes to a traditional IRA. Those that investment that you have in your individual retirement account has the luxury of growing tax free. So that means that as your funds grow, if you have it invested in particular stocks or however you have your money chopped up in your IRA, the point is that as you continue to make gains, you're not, it's tax deferred. You're not going to get any, you're not going to get taxed on it. You only get taxed when you withdraw the money. When you take the money out, that's when Uncle Sam comes for you in a traditional IRA. Now, moving on to the next topic, withdrawals. When you take the money out, normally with an IRA, you have to wait until the age of 59 and a half. But after the age of 59 and a half, your taxes, your withdrawals are taxed as ordinary income. So basically, almost like as if you were getting a paycheck. Um, if you withdraw before the age of 59 and a half, you will most definitely face penalties and taxes. There's only a few certain circumstances they allow early withdrawals, but for the most part, you're usually penalized for that. And then as you keep growing that money in that traditional IRA, um, you will be required once you hit a particular age. I believe as of the year of 2023, the minimum age was at 73 years of age. You have to start taking what are known as required minimum distributions. And every IRA is different with how large those required minimum distributions need to be. But it's basically you have to start taking the money out even if you don't need the money because an IRA is built that at a certain age you need to start taking the money out. So that in a nutshell is a traditional IRA. Now, the second one that we're going to cover, a Roth IRA. This
I have a
one is
quick question,
different.
Lee.
Yeah, go ahead.
So now, would it behoove people if they have to pull money out of that IRA to set up a new one?
Um I don't think that would probably be the best use of doing it. I mean, if you're gonna start putting money into something else, then I mean you should already start to ask, well, I mean, what are your returns on that initial pool of money or where you have it? That's where my question would be. But I'm always looking for a good return on investment.
Yeah.
But that
So you know what, and again, this just goes to our show here. It's like we want to be able to give you guys the best information as possible. It's like
it's a cheat sheet.
I kind of
It's a cheat
knew,
sheet.
yeah. Exactly. Your financial cheat sheet. And you know what? And honesty is going to be transparent. So this is why I kind of knew that answer. I just wanted to make sure that, and Damien, he's my best friend, my brother. I sit there and we do this to each other all the time. Give each other questions where we know the answer. We're just going to make sure, hey, you know what? We're always going to be on the up and up for you. So I just wanted to make sure. And Damien,
Keeping you honest.
but
All right.
so take it away. Take it away. I'm sorry about
No,
that.
no, no. Good stuff. Good stuff. Financial underwear. Anyways, so a Roth IRA. So a Roth differs from a traditional IRA in the sense that you can still make contributions to it. The only difference is that these are after tax dollars. So what does that basically mean? That means that you will not get an upfront tax break like you would with a traditional IRA. Your investment will grow tax free. You won't owe taxes on the growth. The problem is that with a Roth IRA, you don't have the ability because you're paying your taxes kind of upfront. And there is an advantage to that though. The advantage is that you've already paid your taxes. So I'm going to give you a really good example. So Robert, you had been working at a company, investing in a Roth IRA, and for 10 years, you were able to go ahead and put away, let's just say, $20,000. Okay. Fast forward 20 years, 25 years. And all of a sudden, you're like, oh, I'm getting towards that. Yeah, let's go ahead and see what that's at. It's obviously going to be probably in the six figures.
Mhm.
But the beauty of that is that you already paid your taxes on it. Because if you let that money grow and you already paid your taxes, whereas a traditional IRA, when you're taking that money out, hey, just like a paycheck, you got to pay taxes on it. Uncle Sam is still going to get his piece. And so I know the shivers. But that's a real benefit of a Roth IRA is that if you invest a pool of money and you're able to sit on it or keep contributing to it, even better. Um, you've already paid your taxes on it. And trust me, that is going to be worth its weight in gold when it does come time to retire. So
So
that's where go
so
ahead, Robert.
big picture here is when you set up this Roth IRA, you know what, and you set it up properly and you're putting money into it. When you pull money out of it, they again, like you mentioned, I don't mean to beat a dead horse. It's like I'm not having to pay taxes on that anymore because I've paid it initially.
Initially.
Yeah, yeah, that
Initially. You're always paying it on the year that your contributions are being done. And then that counts as income on normally. So it gets added. So that's why there is no tax break. That's why they say there is no tax break with the Roth because you're paying your taxes up front. You're not waiting until that money grows into a real large sum. And then guess what? The tax man's right there, Robert, waiting to get a piece. So that's the difference. So, and then withdrawals, though. I digress. Let me finish that with describing the Roth IRA. Withdrawals from a Roth IRA in retirement are tax free, like I have been discussing. Um, you always have to have that account open for at least 5 years, though. So if you're over the age of 59 and a half and you've had your Roth IRA open for 6 years, 7 years, you can go ahead and start to take that money out tax free. And here is the other major difference between a Roth and a traditional IRA. In a Roth IRA, you're not required to go ahead and have a required minimum distribution. So if you live to a very, very ripe old age, and you're not required to have to take the money out. Whereas with a traditional IRA, once you hit 73, hey, you better start taking money out. Whereas that rule does not apply to a Roth IRA. And so that's essentially a Roth IRA in a nutshell. Those are the two major IRAs that individual retirement accounts that are most commonly used all throughout the United States. There's two other types of IRAs that are not as popular, mostly because they're more niche kind of IRAs. They're more meant for a specific audience. The first one is an SEP IRA, and that is an acronym for a simplified employee pension IRA, which is often used by small business owners or self-employed individuals. So, and then the other one is a simple IRA, which is basically a savings incentive match plan for employees. It's another kind of employee sponsored plan, but once again, it's mainly geared towards small businesses. So you don't see a lot of those used as much because in reference to the greater population to small business owners, obviously there's a lot more people in the greater population. So that in a nutshell covers IRAs, your individual retirement accounts. And so that's going to be a really important topic because we're going to be bringing this up in later episodes as well. But that's your financial guru tip for today. I know it was a bit long, but go
And
ahead,
you know,
Robert.
make it a quick recap on that because I want to make sure I have this clear here. Is so for a traditional IRA, you know, I can expect tax deductibles, tax deferred, okay, taxes as an ordinary income, you know, so I get taxed upon that like it's income, and then you know those
Only after you
RMDs.
start taking withdrawals. It
Okay,
gets
okay,
taxed as ordinary income once you start taking withdrawals. So
and then
remember
those.
that.
Okay, cool. And then the last one was, and because you know the banking world is full of acronyms, is the RMDs, the mandatory minimum
Yeah,
distributions.
it's the required minimum distributions only apply to traditional IRAs. They do not apply to Roth IRAs.
Okay, perfect. And you know that's, and I'm gonna be honest with you, Damien. It's like I know I'm not gonna live forever, but much like my credit score, I'm gonna try to make sure I'm as healthy as possible so I can reach that 73 age limit. And then you know what? If I do, and you know, I'm gonna be honest with you, I have one traditional IRA, you know, so I will have to incur some of these.
I still have a traditional IRA.
Yeah,
I have much more in my Roth, but I'm guilty too,
but
and it's
it's still
okay.
playing both
Yeah,
sides. Playing both
yes, you
sides, you
can.
know, we're you know, it's like having, and again, at the end of the day, you know, we here at Loan and Key, we want to be your financial cheat sheet so you can actually understand everything that you're doing, you know. And then so the Roth IRAs, you know, their contributions are after taxes, you know, so you won't, you know, you're paying your taxes up front, you know.
Yep.
The which so that means that the withdrawals, they're tax free, so you're not being, you know, penalized on anything, because believe me.
When you get your money, you get all of it, and because Uncle Sam already got paid. He already got paid because it's a Roth. That's the beauty of a Roth, man. It's I'm sorry, it's cool, man.
And you know what,
And
and I don't mean to deviate, because you know what, this is a huge lesson that I want to share with everyone. You know, I had I have a 401k, you know, I still do, I have a couple of them, but on one of them, I decided to take some money out because I was in a pinch and I didn't have this financial savviness that I have now. And you know what? It cost me big time came tax season. You know, it's like Uncle Sam called my employer and said, "Hey, guess what? You know your boy Robert, he's getting money taken out of his paycheck, and we don't care what it looks like afterwards." And that, oh, that
that's why I mentioned taxes and penalties. Early withdrawals, that's the bad part with any traditional IRA or 401k, and they will take out extra taxes and you will be penalized. And those penalties normally come in a form of a one-time fee, basically like Ticketmaster. And so
what?
literally, and that fee is hefty. That fee is hefty, and so that's why, just to go back to what you were saying, Robert, it's just doesn't pay if you have a 401k or an IRA. Do your best to just not take the money out. I mean, if hopefully if you can avoid it, if it's an emergency, I get it. I've been there too, but I mean, if you can not touch that money, it is just so worth it to just let it sit there and grow.
And this is also a good segue for us to mention here at Loan and Key. You know, if you are in that financial situation where you're like, "Hey, I need some money," you know, like now, you know, reach out to us, because if you're a homeowner, we can talk about HELOCs. home equity line of credits. Those are huge. It's like those are honestly one of the biggest things in the market right now. And you probably heard and I would have to say, if you've been on YouTube, Hulu, if you've been on, Netflix, and you have the commercials still, you've seen that Rocket Mortgage ad. Again, that's a big lender. They're going to give you their rate. They're not brokers. They're just going to give you their rate. We at Loan and Key, we can shop HELOCs for you so we can make sure you get the best rate. Because again, a home equity line of credit, it's basically we're gonna be able to say, hey, how much equity do you have with inside of your home that you've built up over the past year or two? And then they're basically going to give you something like a credit card and say, here, go ahead and spend it at will, whatever you want to. But we want you to be financially sound and savvy with it. Don't pull out a HELOC to go buy a boat, because then you're paying interest twice on something you shouldn't. It's like, because again, HELOCs, if you're gonna, now I will say this, if you're gonna pull that money out to do upgrades on your house, bravo, but if you're gonna, get it to be in debt further, as your loan officer and your mortgage advisor, you're probably going to hear me on the other side of the phone say, why? Why?
There's no need to use your equity in your home like that. There's
No,
just not,
no,
and us here at Loan and Key, we're not going to advise you to do anything like that. It's always going to be looking out for your best interest. That's why we shop rates. That's why we look around. We're not Rocket Mortgage. So
we're not Quicken. We're not
no,
any of those big places. We're not the big box place. Hey, we're, if I'm going to say it like this, you look at those supercars, they're not these big old Escalades. They're small powerhouses that move fast and get you to where you want to be. And we do it in style. We want to make sure you get there, and that style is making sure you're financially sound. So again, Loan and Key, we're here to do that for you. And Damien, I want to say thank you again for each week that joining me. Again, I'm glad Tarah's in meetings right now, but at the same time, we miss her. She's awesome. It's like she provides an element that Damien and I can never provide, and it's not just a friendly face. It's financial sound advice as well. It's like having that, we're the three amigos here, trying to make sure that you guys have, your financial cheat sheet, and that's going to be Tarah Read, me, Robert Sierra, or Damian Gutierrez, and with that being said, we hope you guys have an amazing weekend, and look out for our next video because they're going to be coming in hot. Talk to you guys later.
Take care.